Bitcoin just dropped again, now sitting at around 110,000, and the markets are bleeding red. Between a U.S. tariff war, growing fears of government shutdown lasting, and one of the most unaffordable housing markets in American history, investors are asking, is this the bottom or just a dead cat bounce before another leg down? Stay tuned because we're breaking down the truth behind the drop, what a dead cat bounce really means, and how all this connects to the bigger story in Bitcoin, inflation, and the U.S. economy. What's up, family? It's Coach Masi, and you're locked into the Daily Hodl. This is where we break down the biggest financial news, Bitcoin insights, and market trends so you can stay informed, disciplined, and ready for opportunity. Well, let's dive in. First, we're going to zoom out and look at the big picture. Friday's market meltdown caught a lot of investors off guard. Equities tumbled, tech stocks took a serious hit, and Bitcoin plunged sharply, wiping out gains before staging that quick bounce on Monday. Well, here's the reality. That rebound might have been nothing more than a dead cat bounce, a short-lived recovery after a steep decline that tricks traders into thinking the worst is over. When in reality, the market is still digesting major stress, and I'll talk more about that later. You see, this is a classic market psychology in action. Prices fall sharply, fear spreads, sentiment collapses, bargain hunters step in, prices bounce temporarily, and then gravity often takes over. So why is this happening now? Well, several forces are converging. Liquidity is tightening, making it harder for markets to absorb shocks. Government uncertainty is rising, from tariff tensions to the longer potential shutdown lasting. And institutional investors are moving cautiously, accumulating quietly while the crowd panics. The result, volatility is back, and it's creating both short-term challenges and potential long-term opportunities. For traders and investors who understand market cycles, moments like this are where smart positioning can pay off big. Bitcoin, equities, and even traditional markets are all dancing to the same tune. Uncertainty, liquidity, swings, and institutional behavior. Recognizing this pattern is key to staying calm, disciplined, and ready for opportunity. I'm trying to teach you. Pay attention. Now let's focus on two headlines currently rattling global markets. Tariffs with China and the looming threat of the government shutdown lasting 30, 40, 50 days. The tariff war with China is heating up again, injecting massive uncertainty into global supply chains. Every new headline about tariffs or trade negotiation triggers immediate reactions in equities, commodities, and crypto markets like Bitcoin. You see, investors and traders hate uncertainty, and tariffs deliver it in spades. Shipping delays, cost pressures, and supply disruptions ripple across the economy, creating short-term volatility while smart money positions itself for longer-term pictures. You see, in Washington, politicians are again playing chicken with the potential government shutdown lasting. If it happens longer, federal spending pauses, essential contracts stall, and investor confidence continues to take a hit. The ripple effects go through Wall Street, consumer sentiment weakens, business delays, and contracts don't get going, and it's just a problem. These macroeconomic headwinds create a perfect storm for short-term pain and market turbulence. But here's the important part. History shows that periods of high uncertainty are also when opportunities emerge for those who understand market dynamics. This is where Bitcoin enters the story. While traditional markets react to headline risk, Bitcoin often behaves differently. Its decentralized nature, fixed supply, and growing institutional adoption means it can absorb shocks, accumulate value quietly, and even thrive when fear dominates traditional markets, the things that altcoins can't do. In short, what looks like chaos for most investors could be strategic accumulation windows for smart money, setting the stage for Bitcoin's next move. Peter Schiff, he's a doomer, but we're all hodlers here. And let's move into Bitcoin more. After the massive liquidations last week, we saw a strong bounce Monday. But now the market's cooling again to this 110,000. Some traders call this manipulation, some call it consolidation, but I call it the accumulation zone. Institutions are watching this volatility closely. Remember, the same thing happened in 2017. Again in 2020, markets crashed, weak hands got shaken out, and smart money started quietly accumulating while everyone else panicked. Remember, you wished you could have bought at 110 when it was at 124. So if you zoom out, the fundamentals of Bitcoin haven't changed. Supply is fixed, demand from institutions keeps rising, liquidity cycles are about to turn, and once the Federal Reserve signals the start of new liquidity injections or rate cuts at the end of the month, Bitcoin and other risk assets historically move higher. So while short-term traders are panicking over every candle, long-term investors focus on conviction. Even seasonality is going to play a part soon. So let's break down that term, dead cat bounce, because it's one of the most important phrases early investors, especially in crypto, should understand. In finance, a dead cat bounce is a short-lived recovery in the price of an asset after a major decline that I mentioned earlier. The name comes from the idea that even a dead cat will bounce if it falls from a great height, meaning the rebound does not reflect real recovery, just a temporary reaction to oversold conditions or panic buying. Did you know what that meant? So, here's what makes it tricky. During a dead cat bounce, retail investors often get fooled. They see a sudden spike in price and think the worst is over. So they buy in, only to get caught when the assets continue the downtrend again. See, we're seeing this dynamic play out right now in both equities and crypto. Bitcoin fell sharply after last week's massive liquidation, bounced back Monday, but now is hovering near 110 again. You see, to the casual trader, this looks like a recovery, but in reality, it's likely a temporary pause before the next big move, either up or down, depending on liquidity flows and institutional positioning and macroeconomics. So here's the takeaway. In every cycle, what looks like a dead cat bounce to retail investors often becomes a launch pad for smart money. Institutional investors use these brief rebounds to accumulate assets at lower prices, setting the stage for the next leg up, building a new foundational floor. So instead of panicking or chasing the bounce, understanding market structure, liquidity cycles, and accumulation patterns allows you to see opportunity where others see fear. Recognizing a dead cat bounce can be the difference between getting caught on the wrong side of a trade or positioning yourself for significant gains in the Bitcoin and other risk assets. See, they buy in, it drops, and then they really get fearful and sell again. Now, let's talk housing, because what's happening there is historic, especially as a former landlord and real estate investor. The U.S. housing market is officially the most unaffordable in modern history. And here's how that's measured. Price to income ratio, the median home price divided by the median household income. You also have the housing cost burden, the percentage of income spent just on mortgage payments, principal, and interest. And then you have affordability index, comparing the income needed to qualify for a median home versus what the average household actually earns. So right now, all three metrics are flashing red. The average American family can't afford the average American home, and that's so sad. You see, higher interest rates have doubled mortgage payments in just a few years. Meanwhile, wages, well, your earnings, they haven't kept pace with inflation or housing costs. The squeezes consumer confidence, slow spending, and can even impact Bitcoin indirectly as well. Because when liquidity tightens in housing, people have less capital to invest in alternative assets. But here's the flip side. Once rates begin to fall, which they are, we could see a massive rotation of capital back into risk assets, Bitcoin, real estate, and stocks. So short-term pain could equal long-term opportunity, and that's what I'm banking on. So how does all this tie together? Well, you've got a tariff war that's hurting trade, a government shutdown that's threatening liquidity, a housing market under extreme stress, and a Federal Reserve that will likely need to pivot to avoid recessions, especially again at the end of this month. You see, that's the setup that historically leads to monetary easing. And when money starts flowing again, Bitcoin thrives. Bitcoin isn't reacting to just price, it's reacting to policy, liquidity, and institutional confidence. And right now, we're sitting in a moment that looks a lot like late 2019, before the halving, before the stimulus, before the next leg up. So the question is, do you think this is just a dead cat bounce or the calm before the next Bitcoin breakout? Drop your thoughts in the comments below. What do you think happens first? Fed rate cuts, Bitcoin all-time highs, or a housing correction? And if you found value today, don't forget to like this video, subscribe to the channel if you haven't already, and share it with someone who loves Bitcoin and financial news as much as you do. Remember, this content is not financial advice. It's for educational and awareness only. But always do your own research, and remember to stay informed when you're spending your money. Well, that's your Daily Hodl. Stay sharp, stay disciplined, and as always, Lead.Pray.Hodl. I'll see you in the next one.